Howdy, Jacob here. Today we're looking at Mativ Holdings, ticker symbol MATV, 2.58% dividend yield. That's very low. I don't know how it hit my screener of 4%. I guess it was as low as $10. Okay. So it was as low as $12 and has increased 40%. So this would have been probably right there at the 4% when I looked at it. But it's already dropped down to 2.5. Ooh, $840 million market cap, $2.5 billion enterprise value in the paper forest industry. Oof. Okay, so let's look at this debt here. 152 million long-term debt in 2012 now has nearly 1.7 billion long-term debt. 5-year average free cash flow. Let's say, let's just go over here and say it's about 110. Let's say 100, even 100. That would be 16 times their 5-year average free cash flow for long-term debt. Absolutely not what we want to see. That's way too much. It looks like they went into debt to make some acquisitions. It's going to be tough to say that that was worth it, given that their greatest 5-year cash flow has been 142 million, and even 142 million, they have over 10 times that amount. That's not what you want to see. And a company that is a dividend company means that, especially with a high payout, we're seeing, maybe it's over 50% because they definitely haven't averaged 140 up here. We can say 100 just to be make it easy, and that's still 70% payout. That means they can only do 30% rest to pay down debt, which is a very high amount. Um, yeah, it's just gonna be tough. I don't know when their debt is due on a lot of this money, but I would say that they're gonna have to push down a lot of this debt just for the lenders to be confident that they're able to lend to them. I think that's a huge concern for me, and just right off the bat. I mean, if we exclude the debt a little bit and just keep it in the back of our heads, I think I'd like them to cut this dividend by two so that their payout is roughly 35%, 36%, 5-year average, then use over 50% to pay down some of this debt. It looks like they do use a lot. They do make a lot of acquisitions. That's also concerning because they they go into debt for these acquisitions, and so that's a huge concern. Debt should be viewed on a company like individuals. So if I were to hold $1,000 in debt and my neighbor held $1 million in debt, all else equal, they're going to be a whole lot easier to go under than I am. And it's the exact same for companies. A company with 1 to 2 years free cash flow, their 5-year average free cash flow in debt is going to be tough for them to go under because if a lender were to say, "Hey, we need this money now," there's a good chance that they could either get money from another lender to pay for it, or they'd be able to pay for it themselves and be debt free. Whereas if you're 15 times the 5-year average free cash flow, there's no way you're going to be able to pay down that debt immediately, and then it's going to be nearly worst case scenario where the company goes under and you're going to have to liquidate everything you have. And so right now, I think if we just cut that dividend in half, that's going to be okay. If we look at the revenue growth assumptions here, 773 million to 2.1. Again, that was heavily due to acquisitions the last 2 years, but even 773 to 1.1 nearly in 2020. I might assume 3% revenue growth, 13 on the P price free cash flow to say, hey, you know what? Actually take that back. They're in the paper and forest industry. I might do 1%. Say that the growth, the company itself is going to lose, but through acquisitions and inflation, they'll increase a little bit. And then I bumped the P down to 12, saying They might have still growth ahead of them, since I wouldn't necessarily say it's going out in the next 7 years, but I don't think it's going to be thriving necessarily. And as for margins, let's look at some averages up here, 6 and 8. But what's their debt? So 1.6. If that were to increase 2%, we're looking at roughly 60. Oh gosh, 60 million. That's going to be cutting this in half. So maybe do 4 and 6. Share change. Let's assume they don't issue a whole lot of shares to fund acquisitions. Let's assume I'm actually going to bring these down a little bit more. 3 and 5 on the margin side. Again, that's because they have so much debt. Just a 1% or 2% increase in debt when they refinance is going to very much hinder their margins. As I was saying, that 2% on 1.6 billion is roughly 60 million. Oh wait, that's not right. What was I doing? 2% would be about 30 million, which would decrease their 5-year average 30%. All right, I might bump that back up to 4 and 6. That's fine. Even yet, the company would have to fall 19%. So right now, with these assumptions, it looks like it's pretty close to a 15% return. Uh, if it drops a bit more, I'll try to do an in-depth analysis on it, see whether these figures I'm putting are appropriate or not. But I have huge concern with debt companies, and sometimes even if the numbers make sense, like they did on EBIX a little bit ago, I did an analysis, and from a numbers standpoint, excluding the balance sheet, it looked like a screaming deal because their 5-year average free cash flow was, I don't remember the numbers, but it was selling for like 3 times, 4 times 5-year average free cash flow, and they were producing cash flow very consistently. But they had so much debt, and the company is now liquidating, and so you have to be concerned with debt. And so this analysis doesn't take debt into consideration, but you have to when you decide to buy a stock or not, and also put it in your margin. But sometimes that doesn't do anything. And so if a debt is so high it's concerning to you, then just don't invest in it. There's way too many companies out there for you to want to reach and be concerned about a company that might go to zero. If that's not worth it for you, don't do it. And so I hope everyone has a good rest of their day, and thank you so much.